In this month's Economic Update, Kaplan Professional's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollock, and this month we're speaking to columnist for The Australian and independent commentator Don Stammer. Thanks for joining us today, Don.
Thank you, Michael.
So firstly, looking at Australia, Don, given the weakness in the housing sector, downward pressure on the Australian dollar and persistent low inflation, what's the likelihood of another interest rate cut this year?
I think the Reserve Bank's planning to keep the cash rate at 2%, which it's been since May, but to reserve the right to make another cut if the international environment deteriorates. I don't think the Reserve Bank yet would see weakness in the housing market. They'd probably see it stabilising after years of very strong upward moves. The Reserve Bank obviously will keep a very close watch on prospective inflation. At present, inflation's running at the bottom of its target range of 2 to 3%. The Reserve Bank's rather happy with the way the Australian economy's grown a little bit more rapidly than most people expected. So I think it'll sit there looking at things in detail. My guess is at the end of the year the cash rate will still be 2%, but if the global environment requires a cut, they'd be prepared to make it.
What's your target for the Aussie dollar this year?
My guess is we'll see the Australian dollar lower than it is against the US dollar. The US dollar hasn't done as well and moved up strongly in recent weeks as it was doing last year, but I do think the US dollar this year will turn out to be the world's strongest currency, simply because the US economy is in better shape than other countries. I think we'll see the Australian dollar down to 65 cents US. That's assuming the US dollar moves up. But I would say to people in Australia, it's unlikely the Australian dollar will fall as much as a lot of people in business would like it to. And the reason I say that is some parts of the Australian economy are doing very well. We now have 650,000 overseas students in Australia. We're starting to do much better with exports of agricultural products. So Australia isn't the basket case we were, say, in 2000 when the Australian dollar fell to $2 to the US dollar, and again when we fell sharply during the global financial crisis. I expect the Australian dollar will go down. There's a lot of uncertainty, but I don't think it'll fall as much as a lot of people are calling for.
What do you expect to be the major global impacts on the Australian economy this year?
There are three international impacts that I would suggest people look in very carefully at. One of them is China. At present, everyone is very gloomy about China. I think China will avoid a hard landing. The second is US interest rates. Clearly, US interest rates are going to go up. The question is how much. And the third international impact will come very much from the price of oil. The price of oil has dived recently. Too many people say it's because the demand for oil is falling off with the global slowdown. The real problem for oil is oversupply. There's so much supply came on stream last year, and there'll be additional supply coming on now that Iran is back to producing oil that can be sold in the West. And if you look at inventories of oil around the world, they got to 1 billion barrels of oil currently sitting in ships and storage all around the world. They're the three things people should look out for: the US interest rates, China, and of course the price of oil.
What's your overall outlook for the Australian economy in 2016?
I think 2016 for Australia will be quite like 2015. It'll be a year of modest growth, say 2.5% to 2.75%, but doing a little bit better than a lot of people expected a couple of years ago when the mining boom peaked and particularly mining capital spending started to fall. The best sectors in Australia will be infrastructure spending, especially in New South Wales. Also, housing construction is still at a high level, though it's now plateauing. Exports of education, health services, agricultural products, and some manufactures will be the strong points. Business capital spending, though, is very slow to get going again, and we haven't seen yet mining investment fall to the 2% of GDP it's destined to be, having peaked only 4 years ago at 8% of GDP. So a modest year, but better than a lot of people have been expecting.
Turning to the US, what's the likelihood of the raft of recent poor results across the US earnings season delaying further rate hikes by the Fed?
I think the US Fed, the US Central Bank, will be cautious and very slow and very drawn out in pushing interest rates up in America. What worried the market in early January was suggestions from the senior people at the Fed. They were looking for 4 further increases in the cash rate in America during 2016. That's on top of the one they announced in December. And that worried a lot of people, not only people in the energy sector in America that's going through a period of horrors, but a lot of businesses, a lot of investors in America said 4 cash rate increases this year will be too much. My guess is after the turbulence we've seen in financial markets, the Fed's probably now more thinking of 1 or 2 further cash rate increases this year. The difficulty for the Fed will be if wage increases start coming through or inflation picks up in America. There are 1 or 2 worrying statistics now coming out on wage increases in America, and that might force the Fed to be more quick in putting up the cash rate than I've suggested. But overall, I think 1 or 2 increases in the cash rate this year, that would still leave the cash rate in America well below 1%. Nothing to be fearful of, but I think the fear of the Fed having to speed up its program will occasionally unsettle investment markets.
What will it take to stabilise the US dollar?
The US dollar, well, a lot of people would like to see it stabilise because the US dollar is still the world's currency, and the great uncertainty about the US dollar and the extent that it has moved up worries a lot of people, and not only in the US. I think exchange rates are very hard for governments and central banks now to stabilise, but I do think we're not going to see the US dollar move up as quickly as it has done in the last year. Probably move up a bit higher. But there'll be times when, say, the US comes up with 1 or 2 months of very worrying unemployment numbers, just because of the way numbers are collected. There'll be times when the US dollar wants to sag a bit. But I do think we'll see the US dollar move higher against other currencies because of the underlying strength of the US economy, but there's going to be a fair bit of turbulence in foreign exchange markets once again.
What do you think will be the drivers of the US economy throughout 2016?
The main driver of the US economy is personal consumption. Americans like to spend and Americans don't like to save. So given the very high propensity to consume in America, it will be spending on consumer goods that's driving the economy. We're seeing it at present, particularly for motor vehicles, but the cheap cost of petrol is also adding to consumers' ability to go out and spend. Just at present, there's still some caution. The American saving ratio has moved up to about 6%. Long term, you expect it to be about 0. So it'll be consumer spending that helps. And the fact that the unemployment rate in America, as measured, is now below 5%, and employment growth in America has been fairly good, though, and sadly not for people with very few skills and on low wages. But overall, the American economy is producing jobs, confidence will start flowing, and it will be consumer spending above any other item of spending that motivates the economy. I feel quite confident the US economy overall will have 2 to 2.5% growth this year. Not spectacular, but given how much the US economy has picked up since the dark days of the global financial crisis, not a bad outcome.
So just looking at China, Don, what risks do increased capital outflows and the subsequent depletion of FX reserves pose for the Chinese economy?
China's foreign exchange reserves have dropped from a massive $4 trillion to about $3.3 trillion. Some of that's valuation. China's still running a huge trade surplus, but there certainly has been capital outflow. A lot will depend on the outlook for the Chinese economy. At present, the assumption of most people looking at China is that China is having a hard landing. I think there's more resilience in the Chinese economy than that. Consumer spending in shops is still up more than 10% in the last 12 months. Chinese services now exceed manufacturing and heavy capital spending. The Chinese economy is reforming, and like most economies that are reforming, it's tough going. But I think it's unlikely China will have the hard landing that's factored into markets, and I think it'll be good for Australia when people generally feel that China's avoided recession. But China is vulnerable. If the Chinese government mismanages the economy or tries to do things and can't deliver them, the chance of capital outflow as China frees up its economy is there. I do think, though, that Chinese authorities will move very cautiously. And it's useful for them that they've switched the measure of the Chinese currency from the US Thai to a trade-weighted index. I think they'll focus on trying to have stability for a while in that trade-weighted index, both to make China look good as they become fully part of the International Monetary Fund, currency arrangements, and also to show that they can manage a trade-weighted exchange rate really well. So overall, I think there'll be worries about China. There's a vulnerability worse than in other years, but at the end of the day, I think that people will end this year saying China avoided recession, we didn't see the capital flight that people feared, but it does require the Chinese government improve its economic management, and that's something I think will happen, but obviously it'll be something people will need to watch very closely.
And finally to Europe, what would be the major ramifications should Britain actually exit the European Union?
I think it would be negative if Britain does pull out of the European Union. Incidentally, it would also be devastating for the Conservative Party, which is massively split on that. The best arrangement for Europe, the best arrangement for the UK and the best arrangement for the world would be some renegotiation of agreement within the common within the common market, giving Britain better independence on some issues of policy, reducing the power of the bureaucracy in Brussels. That would be the best outcome. But if Britain can't negotiate some freeing up of the excessive controls from Europe and Britain pulls out, it would be negative for Europe, negative for Britain and negative for the world.
What are your expectations overall for the European economy this year?
Europe faces a lot of problems. It is over-regulated, it's over-taxed, and now of course they have the huge issue of refugees, and those issues will continue next year. That said, fortunately Germany is a very well-functioning economy. My guess is Europe as a whole will have growth of 1 to 1.5% this year. That sounds pretty skinny, but of course this time last year people were feeling contraction. Europe also has the risks of a period of deflation. There's so little inflation in Europe that people are worried about falling prices. And as Japan is finding, when prices are falling, it's hard to get people to spend. It also complicates things for interest rates. Europe also still has the anomaly of a one currency for so many different economies, including Germany, which is a world powerhouse, and Greece, which has all sorts of continuing problems. So Europe has greater problems than, say, the Western Pacific has, but that said, I do think Europe will have growth 1.5%. It's not a lot, but it's better than the contraction people have been fearing.
So just finally, where do you stand on the view that the world economy is headed for recession?
Certainly a lot of people have been saying the world's looking at another recession, and they're thinking, of course, of 2008, 2009. I remind people that share markets often turn very gloomy, and we saw in 2011 a severe fall in share prices. People said the American economy would double dip into recession and China would have a hard landing. Not every time you get share market turmoil and gloom do you have a global recession. There's certainly been not huge growth of credit in America. American banks are well run. They've recapitalised. Inflation is low. The central banks around the world are pumping money into the economy. I'd put a very low probability on a 2016 recession, and I think what people have got to say is share markets jump at shadows. Are they doing that in the early part of 2016? I think they are, but obviously there's a lot to worry about. The world is a pretty difficult and complex place, but I think at the end of the year we will find that the conditions that normally produce a recession haven't reappeared. There's no special reason for a global recession, and we'll still be talking about world growth being less than we'd like it to be, but not in a recession.
Thanks very much for your time today, Don.
My pleasure. Thank you, Michael.